Good day, everybody. Hope everybody is doing well. So, we are going to talk about a mortgage calculator. So, when you are in the market, when you are trying to buy a house, so usually you go to a bank or a credit union to get a mortgage to buy the house that you are planning on buying. So, generally, when you buy the house, there will be certain amount of price for the house that you negotiate to buying, and the amount you want to put as a down payment, and there will be for how long you're going to be buying the mortgage for, and what is the interest rates. So there are various different parameters when you try to buy this mortgage for buying the house. So, and also there are different types of mortgages that you could be taking the mortgage for. So we're going to go a little bit more about those mortgages and how much it's going to be. Basically, you have to be paying, say, per month in terms of making the payments when you take the mortgage for how many years. So this calculator will help you to figuring out how much what kind of mortgage you're going to be taking on, what will be your monthly mortgage payments, and other, basically, if you have any PMI, any kind of insurance amount that you have to pay as a result of taking these mortgages. So we're going to cover a little bit more about all those things. Hope this will be helpful. Thank you. So before you start to take a mortgage, you would like to know what kind of mortgages that you are considering applying for. If you go to this website, bankrate.com, it's a very popular website that explains you types of mortgages that are currently available for the home buyers to take those mortgages on. So there are typically 5 different types of mortgages. One is the conventional loan. When you take the loan for this buying this house, the mortgages. So these kind of mortgages are basically are best for the borrowers with very high credit rating, especially if you have a very high FICO rates. And also there is a limit how much you can borrow. I think currently for 2022, the conforming loans are basically are covered up to $947,000, about $947,200 in most of the areas. Or if you're going to some big cities where the homes are more expensive, it could cover up to a loans for the amount of $970,800 in the expensive areas. And also you have to have very high FICO area. And this also explains some of this in the pros and cons of taking those mortgages. Say, for example, you have to have like a FICO score of about 620 or higher, those kind of things. Another kind of mortgages is the jumbo loans. So jumbo loans are the ones, basically, if you want to buy a bigger, more expensive homes, the credit rating, your credit rating has to be really high, and you want to buy a house more expensive, something like more than $1 million or something. So this is when you want to buy a jumbo mortgage. So especially in more expensive cities like LA or San Francisco or New York City or in Hawaii in certain places. So to get a jumbo loans, you have to put a down payments of about 10 to 20%. You have to have a FICO score of 700, or typically that is required. And you can get a loans above, basically, which is not covered by the typical conventional loans. Then you can apply for a jumbo loans. Another kind of mortgage is basically the government insured loans. So government insured are the loans are basically government plays a good role basically in helping Americans to become home buyers. So there are three types of government mortgages agencies that help in people buying houses. So one is the Federal Housing Administration, FHC loans. The other one is US Department of Agriculture, USDA loans, and the other one is the VA loans. So the FHA loans are backed by federal housing administrators, so help them, mortgages with lower FICO, like around 580, and then they can help, getting a mortgage. The USDA loans are basically in the agricultural areas, rural areas. They want to help in getting those kind of loans. VA loans are the veteran administrators. They want to get those, the people with the military, active duty veterans. They want to get those loans. So the VA veteran administrators, administration, they help you helping getting these loans. The other types of loan is the fixed rate mortgages. So fixed rate mortgages are the ones basically that how long you're going to be getting the mortgages for. What is the interest rates? Say, for example, I'm going to get this mortgage for 15 years or 20 years or 30 years. I want to get this mortgage and the interest rates. The other types of mortgage is the ARM, adjustable rates mortgages. So ARM is the one you basically have it initial period, say like 7/1 or 5/1. So for the initial period, the mortgage rates are going to be fixed, and after like it could reset after every 6 months or 1 year, depending on the prevailing the markets. So for the ARM mortgage, adjustable rates mortgage, initial couple of years, initial period, the rates are going to be fixed, and then it can reset after every period of time. So this is basically, if you get a good rates initially to get a rate, you want to get an ARM rate, but after initial period, you do not know how much the rates are going to go up or down. So this is what it is. So these are basically like 5 types of mortgages you could apply for and get these loans. Hopefully you got understanding about types of mortgages that are available at this time. We'll go to the calculator now. Now let's talk about the mortgage calculator. Last sections we talked about the different types of mortgages, conventional mortgages, jumbo mortgages, federal sponsored mortgages, adjustable rate mortgages, fixed term mortgages, etc. So let's go to Google and put in mortgage calculator. So here it shows a typical mortgage calculator. Let's select the mortgage calculator that are available in bankrate.com. I will put in the link below in the video that you can use this calculator. So in this calculator, all you have to enter is the home price, the price of the home that you're planning on applying the mortgage for, what kind of down payment you'll pay, for example 20%, or it could be 10%. Terms of the loan, it could be 30 years, 20 years, 15 years, 10 years, and the interest rates, and typically other parameters associated to this applying these mortgages. Say for example, which zip code you're going to be buying this home for, your credit score, your property tax based on the zip code, what the monthly property tax is going to be, any kind of homeowner associate insurance you want to apply for this home. PMI stands for private mortgage insurance, private mortgage insurance. So if you pay less than 20% of down payment, the PMI kicks in. That is to ensure the lender needs an insurance in case the borrower is not able to make the payments. So this PMI is applicable. And also if you have any kind of homeowner association that you are going to be paying every month. So let's take a typical mortgage. Say we are applying for $500,000 house and making a payment of $100,000, 20%. and taking this mortgage for 30-year loan. And current typical interest rates for 30-year, it's around 5.41%. And this is the zip code, your credit score. It could be anything, depending on what your credit score. That might actually, like, say how much interest rates or any points you might have to pay against this mortgage. And say typical property tax is $329 per month. Homeowner insurance, say for example, you'll pay $100 a month. PMI insurance, I'll explain, is going to be no PMI because we already paid 20% of the down payment for the home price. And then homeowner association, say for example, I'm paying $300 a month. So if you put in all this number on the right side in this area, it will give you your overall monthly payments, of which basically a major component is principal and interest. I'll explain to you what is principal and interest, and the other things are like in the optional section. Say for example, you're paying property tax of $320 a month. Homeowner insurance is $100 a month. PMI is not there, like because you paid 20% down payment. Homeowner association is $300, so covering all in all $2,977 for these monthly payments. And in this chart, of which you could see in the green color, $2,248 is basically principal and interest. $300 is homeowner association fee. The green color is the property tax, and this violet color is the homeowner insurance. So overall, basically, the maximum amount is applying towards the principal and interest. So this helps you basically in estimating or calculating, what the mortgage amount you have to pay every month, depending on how expensive, what kind of price you want to apply for the mortgages, or what kind of down payment you pay for this mortgage. And also there is another tabs here in this calculator is the amortization schedule. So in here, if you tell, say for example, the month of May, you're taking the mortgages, you're not doing any additional payment every month or one-time payment. If you pay anything, you can enter it here. To make it simple, we are putting everything like, not picking any other, amounts. So in here, like, this graph says you like, what is your remaining balance at the point, basically when you're starting the mortgage, you're having, say, almost like $400,000 mortgage. And then you have not paid any principal, and the interest is going to be like, out of $2,248. Because this is what is going to be basically towards the principal first month. Interest is going to be $1,800 almost. And the remaining balance is going to be going down from the overall the balance. So every month that you're making the payment, the balances is going to be going down, the principal amount is going to be going up, and the interest payment, because the remaining amount is going to be lower amount, so the interest payment is going to be lower every month. So as you can see in the graph, if you move around, say in about 10 years, in May of like 2032, so you would have covered, like, remaining balance is going to be $327. And then your principal amount is going to be $70,000 that you would have paid. That will be your equity building towards your home. And the interest amount is going to be less. It's going to be $199,000. You have to pay this much of interest paid so far. Similarly, if you move along that time, if you have like in 30 years, when you would have paid up the mortgage, you would have paid off the whole amount. Remaining balance will be, there's no remaining balance. You would have paid all this $400,000 principal amount, and you would have paid an interest of $409,000, almost $410,000. So you're paying more in the interest than the principal of these payments. And there is this monthly amortization, how your principal amount, interest amount, the balances are going to be changing every month over 30 years. And you can print this out for you to analyze, and you can look it into in this graph how this principal amount, interest amounts, and your overall remaining balance is going to be like, changing, as you keep on paying on the mortgages. Hopefully you found it very useful and figuring out how this mortgage calculator works. If you like this video, please hit on the subscribe button so that I am encouraged to create more such videos. And hopefully you enjoyed the video, and see you again in the next video. Thank you very much.